Better System Trader, episode 48.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, this is Andrew Swanscott here, and welcome to episode 48 of the Better System Trader podcast. Trading can be tough, markets are noisy, and finding signals in the market noise can be challenging. Also, applying indicators to trading strategies can introduce lag. However, a lot of traders don't even realize the lag their indicators are introducing or the impact it can have on their trading. In fact, the guest in our chat today, John Ehlers, said one of the biggest enemies of traders is lag. So what's the solution? John is well known in the commodity futures arena, having spent many years researching and publishing unique approaches to trading the markets. He's applied his background in engineering to produce solutions for issues such as indicator lag and market noise, and in today's episode we discuss some of those, including the impact indicator lag can have on trading and some solutions to the problem. We also talk about the applications of digital signal processing in trading, the MESA method of cycle analysis that was pioneered by John, regime switching, plus we have a number of audience questions that John addresses, so listen out for those. But before we get started, a quick word from our sponsor. How would you like to copy the trading as some of the best traders around, automatically taking the exact same trades they take in their own personal accounts? Traders like Michael Cook, Larry Williams, Linda Raschke, or even John Ehlers, the guest on this podcast episode. Well, you can with worldcupadvisor.com. For more information, check the show notes page at bettersystemtrader.com/48. Trading futures and Forex involves significant risk of loss and is not suitable for everyone. And now on to the chat with John. I hope you enjoy it. Hi, John. Welcome to the show. It's great to have you here.
Andrew, it's great to be here. Thank you very much.
So can we please start with just a little bit of background on yourself?
Sure. I'm an engineer. I got my BS in EE and MS in EE at the University of Missouri, and I did my doctoral work at the George Washington University in Washington, D.C. I've been an engineer my adult life and primarily working in electronic research. And I got my interest in trading because one time I got a bonus and I had to spend that money somehow. It was either go into real estate or trade commodities. And I decided I didn't want to be a landlord and fix toilets in the middle of the night. And so commodities it was. That's how I got started in trading.
Yeah. So back then when you were trading commodities, was there any particular style that you were using?
Not really. I started with fundamentals, actually, and chasing rain clouds across every cornfield in Iowa. But being an engineer, I quickly gravitated to the technical aspects. And that's kind of what my story is all about. I asked my broker, why do you use 14 days in an RSI? And why? And he said, because that's what Wells Wilder said to do. And you have no idea how disquieting that is to an engineer. And so I started on a quest to find the best length to use in my indicators.
Okay. Now, this is kind of an obvious question because I know a lot of people know you, but what style of trading do you prefer now?
Currently, I prefer swing trading, or if you prefer reversion to the mean. And I like that because, first of all, I can test it historically over thousands of trades, and I can get a statistical picture of how the system works. And secondly, the results end up with typically with a higher percentage winning trades than other techniques, say a trend follower. And trend following, by necessity, you go in and you take a little bite, and if it works against you, you get out, and you look for another entry, and then finally you go for the big one. But that results in a high percentage of losing trades, in my opinion. So I prefer the higher percentage winning trades with swing trading.
Yeah. Now, as you mentioned, you have an engineering background, electrical engineering. That background sees its way into a lot of your work. So, how do you think trading and engineering interact?
Only tangentially. I used an engineering term. From a technical trading perspective, the advantage an engineer has is it's kind of like riding a bicycle. You don't have to think about it. You just see a situation and you react to it. And so it's a training process. Anybody can do it over time. But I think that's about the biggest relationship between engineering and trading.
Okay. Now, one of the trading approaches or concepts that you're well known for is cycles. So, if you don't mind, I'd like to have a quick chat with you about cycles today before we get on to a load of audience questions, which are really great. So, perhaps we can start with the basics in what are cycles or what is a cycle?
Well, in the most general sense, a cycle is anything that repeats itself. For example, the daily sunrise or the sun going around the Earth is a cycle, or the lunar cycle. The moon repeats. You get a full moon every 28 days or so. All of those are cycles. So a cycle, in the most general sense, is anything that repeats itself.
Okay, so what about in the context of the markets? How do cycles manifest themselves in market behavior?
Well, I guess the first question you need to ask is what causes a cycle. And I asked that same kind of question in college, and the response the professor gave me is what starts a heartbeat. And if you think about a system that's naturally unstable, and you hit it with a little bit of noise, it's going to go in one direction, and then it starts to go in that direction, and it gets a little bit of feedback, and then goes too far and swings back like a pendulum, and goes back and forth under the driving influence. And so basically, market data is very noisy. And I think the listeners can recreate market data fairly easily. Just start with a noise generator, a random source like in Excel, and then apply an exponential moving average of some kind to it. And so that's called noise with memory. And that is a reasonably good model for how the market behaves. And there are cycles that come and go with various frequencies. The cycles that you get in those models and in the real market data are evanescent. They come and they go. They expand and they contract. They ebb and flow.
Okay, now you've pioneered something called MESA. I'm not sure if I'm pronouncing that correctly, or MESA, spelled MESA. Can you explain a little bit about what that is and how it came about?
Sure, I'd be happy to. First of all, MESA is an acronym. It stands for Maximum Entropy Spectrum Analysis. And this is an outcome of an algorithm that was pioneered by John Berg in his doctoral thesis in 1973. He was used for processing data from seismic exploration for oil. And the problem that they have, of course, is with that kind of data is that the data stream is very short. But they wanted to process it, and they used this MESA algorithm. I recognized the relationship between seismic exploration signals and market data, that since the cycles are changing very rapidly in the market, you can only use a short amount of data to process and get a good answer accurately. And so I adapted that MESA algorithm to market data. Now, the way it works is fairly straightforward. There's a two-step process. The first process is you tune a filter You select a length of data. It might be 10 bars or it might be 40 bars, whatever. And you select that length of data and you accurately fit a filter to that data. It's curve fitting in the extreme. And that's where the name comes from. You remove all of the cyclic information that's in that data, and you're left with maximum entropy or maximum noise. So once that filter is created, you take it offline, and then you basically put a new signal source to the input of the filter and see what frequencies come out the backside of the filter. And that's the spectral analysis part. So it's a two-step process, and it's derived from seismic exploration for oil.
Okay, so what are the actual applications for that in trading the markets?
It actually can't be used directly. It's not an indicator in itself, but as I was saying, what is the best length to use to calculate an RSI? Well, an RSI goes from maximum to minimum and minimum to maximum over the period of a half a cycle. And so the obvious best use of a length of data to use for an RSI, or stochastic for that matter, is a half a cycle, if you know what the cycle length is. So that's the purpose of the cycle measurement, is to measure the cycle, take the half of that period, and apply that as the length to use for the calculation of your indicator.
So are there other approaches to or competitors to this approach?
Well, the closest competitor to the MESA approach would be a FFT, or a fast Fourier transform, or even a discrete Fourier transform. Their Fourier transforms basically are inappropriate to use on market data. First of all, you need a lot more data than a single cycle to get a high resolution answer to the measurement. And of course, if you had more than a cycle or two of data in the market, every trader in the world would see it just by his eyeball, and he would jump on it and trade it. So the use of Fourier transforms, I think, is inappropriate. Another reason is that market data is noisy, and that means, for example, it's also fractal. If you look at a chart of daily data and you look at a chart of weekly data, for all intents and purposes, they look the same if you take the scales off. Well, what that means is that the cycle swings in the market are in direct proportion to the time scale. So longer cycles, a cycle that has twice the period will have typically twice as much amplitude swing. So that's an effect I call spectral dilation. So if you're using techniques such as Fourier transform, it's completely inappropriate because you have to somehow otherwise compensate for spectral dilation that's naturally in market data. Whereas if you're using the MESA approach, you're using a short amount of data and typically over a smaller span of the spectrum, and you can generally neglect spectral dilation.
Okay, all right. Thanks for sharing that, John. So I just wanted to change the pace a little bit because you've been doing this cycle research for quite a number of years now. So I'm interested to know, how has cycle research changed over that time period?
Well, I still see cycles being used incorrectly, and that's my biggest concern. I see people continue to try to assign causality to cycles, whether it's the moon or even market cycles or seasonality. They try to assign a causality and then build a model backwards and try to force fit the data to that model. I think that's incorrect. You have to assume the cycles are there and measure them, whatever they may be. They're going to be changing all the time. And the only other thing that I see have changed since I began research is that there's been a lot of changes, like electronic trading has come in and so forth. And so the periodicity of the market cycles has shortened quite a bit in the last 30 years. Just a general observation. The cycle I like to work with in the stock index futures is a monthly cycle. That's typically 10 days up and 10 days down. That seems to be there most of the time.
So what about your opinion or perspective on cycles? Has that changed over the years?
Well, I think the biggest thing that I have changed from when I started, I looked at the linear system theory of the market. I assumed that the market data was an input and you had a good indicator or filter. And if your filter was good enough, you got a good answer at the output of the filter. And then, of course, you had to account for noise. So you just make white noise additive to the input. And so your filter would also have to eliminate the white noise as well. My model of the market has changed since I began, because I now consider market data to be noise with memory, or pink noise. And that gets back to the fractal structure of the market data again. So that they're all tied together. The pink noise, fractals, and data with memory are all basically talking about the same thing. So my model of market data has changed considerably. The analysis of the cycles has not, and the application to indicators has not.
So you've introduced us to a number of concepts already. How do people get started in their cycles research?
I think pretty much the same way I did. They look at the obvious. You look at a chart, and as Yogi Berra said, you can see a lot just by looking. And so you don't oftentimes really need an indicator to assess what the periodicity of the market is. Just look at it, and you can make a pretty good guess at where the market is going cycle-wise. That's maybe the first thing. And the second is not to get locked into a given model and try to make start with a model and then try to make the data fit your model. I think that's a problem that should be avoided.
Yeah. Okay, great. So just before we get into the audience questions, if I can just ask you a quick question about your other work outside of cycles, particularly your digital signal processing work and other concepts that you've taken from engineering and other fields. Now, we haven't actually discussed those yet, but we will get to some of those in the audience questions next. But I guess some of those concepts could seem quite complex to people who don't have a background in those areas, like myself. So for those type of people, can you recommend a way that they can get started in these concepts without feeling too overwhelmed?
Okay. I have to be humble, but I won't be. I think my book, Psychoanalytics for Traders, a lot of people say it's tough going from a technical perspective. And I do introduce some advanced concepts like Z transforms and some other DSP processes. But I try to explain it from the perspective of a trader. It's not my goal to rederive mathematics. I want to show how those mathematics, which are proven technologies, can be applied to trading. And so if a trader has a background in high school algebra and high school trig and a work ethic that he wants to learn how to apply some new stuff to trading, I think my book, Psychoanalytics for Traders, is probably my first choice, actually. Another source that I have a great respect for, Perry Kaufman, and he has an excellent book. I don't know how many editions he has, several editions. It's the fourth edition, New Trading Systems and Methods. That's a pretty good book.
It's like an encyclopedia, that one.
It is, yes.
Okay, so we're going to take a very quick break here. And before we get to the audience questions, let's hear a quick word from our sponsor. Are you interested in trading using MESA cycle analysis, but aren't really sure how to do it properly? How would you like to copy the trades that John Ehlers actually takes in his own trading account? WorldCupAdvisor.com lets you do exactly that, and with the launch of John Ehlers' new MESA Ultra ES program, you can now join John and add MESA trading to your own portfolio. John has his own money on the line, right along with his subscribers on every trade he makes in his account. World Cup Advisor identifies futures and Forex trade leaders through rigorous screening, including live trading evaluation in the World Cup Trading Championship competition, and enables subscribers to mirror their trading buy for buy and sell for sell. As a subscriber, if your fill price is not equal to or better than your lead trader's fill price on any trade, the trade is commission-free from your authorized broker. There are more than a dozen futures and Forex programs to choose from, and you can view complete actual performance data before subscribing. So to learn more, check the show notes page, bettersystemtrader.com/48. And of course, trading futures and Forex involves significant risk of loss and is not suitable for everyone. And now back to the chat with John. Okay, thanks, John. So I think we'll move on to the audience questions now. We've got quite a few good ones here. I think maybe we'll start with Barry, something that you've touched on a little bit already, but Barry asks, what is the most effective use for MESA that you've discovered as a component in a robust, profitable trading system?
It's very, very difficult to use in a robotic system. It's changing all the time, and the major problem we traders have is lag. And if you put it in a robotic system, remember it takes historical data to measure the cycle, and it also takes historical data to create an indicator using that cycle. So as far as robotics are concerned, I'm less than happy with using it automatically. I think its best application is used as an aid in discretionary trading. You can see not only what the current value is, but where it's trending to go in the future. And you can put an eyeball judgment on how to apply it best to your indicator.
Okay. Thanks. Next question is from Nikhil. How can retail traders capitalize on cycles through conventional oscillators, which are ready-made in all the platforms?
Oh, that's a good question. Because things like stochastics and RSIs and MACDs are available everywhere. I have a white paper. I'll take a step back. The usual advice to using oscillators like those is to wait for a turning point and then wait for several bars for confirmation. Well, if you stop and think about it, in a monthly cycle, it's 10 days up and 10 days down. And so let's suppose in round numbers, in computing your oscillator, you have 3 bars of lag in the computation. And then you have 3 bars of lag waiting for confirmation. And then you make your trade actually on the next bar. So you're 7 bars into a 10-bar move. And then on the reverse side, to get out, it's the same way down. So it's a guaranteed loss if you wait for confirmation. The way to use conventional indicators is to anticipate. Instead of buying when it crosses over the 20% mark, buy when it crosses under the 20% mark. So you're anticipating the turning point. So now if you do that, you're basically 3 days in advance, which cancels your 3 days lag of computation. You got 1 day to get in after the move, and so you're right there on a typical 10-day trade. You get in at the optimum point. So I have a white paper where I discuss this. I discuss my research on how I came to this conclusion. And if people would email me at my last name, Ehlers, at mesasoftware.com, I'd be happy to send them that white paper.
Okay, great. Thanks for sharing that. Now, we've got a couple of questions here that are kind of talking about market context or market regime. So first, we'll start with Charles. Charles said he has a broader question on how systems can assess market context, such as seasonal tendencies, pending events, correlations between asset classes, market internals, and CET data. So he'd like to know, is context something that an algorithm can model? And if not, do you recommend that a trader assess market context to determine when or whether to use a systems approach?
It's really, really difficult to build market context into an automatic algorithm. I use support and resistance in my MESA program. That was a program that was a top 10 system for 10 years, rated by Futures Truth, trading the S&P future index. But I came to the conclusion that support and resistance lines are subjective, and a trader has to be cognizant of them because other traders are using them. But nonetheless, they are subjective and very, very difficult to program in. And as is some of the other things you mentioned, like fundamentals and seasonals. So it almost touches on an assignment of causality to things in the market. So it's a model structure that I don't use. It's difficult to program, and I'll leave that to the discretionary traders.
Okay. A similar kind of question from Alexander. He starts off by saying a big thank you for your contribution to traders because he's a big fan of your work and appreciates that you make it available. He starts with a statement, I've used derivatives of your work to differentiate between trending mode, where I favor going with the trend, and cycle mode, where I prefer a mean reversion and liquidity providing approach. I'd like to expand my use of the techniques and would appreciate any insights you care to share. So the question is, have you used cycle analysis to model or describe the relationship between two related markets? And what are the potential ways of using cycle analysis on the lead-lag relationship between the markets?
The short answer is no, I have not. Primary reason is I don't see a product there that is marketable. It's a fascinating subject because it introduces another data stream, and anytime you can introduce more data into your analysis, you reduce the signal-to-noise ratio. I've just not done it. I notice that Alexander's asked another question also.
Yeah.
Whether we have a definitive view on using other things like volume-weighted momentum or price indicator divergences. I'd like to comment on divergences and
Sure.
concept of other additive information. And that is that the trader must be careful to make sure that the added information is orthogonal. That is, if it's just more price data, you're not helping yourself. And in particular, divergences. Divergences are only an artifact of the way you build your filters. An oscillator, for example, will not support a trend line. And so it'll fall off, and you'll get it if you try to use an oscillator on a trending circuit. The trend keeps going up, and your oscillator signal will be falling off. You have a divergence, but it has nothing to do with anything other than the technique that you're using. So I don't think divergences or convergences aid analysis. And if you use other things, you need to use something that's completely different information, like volume or perhaps volatility.
Okay, thank you, John. Continuing on with the regime filter questions, we've got a couple of questions from Sean. He would like to know, have you had any success in using the roofing filter as a regime filter?
I have a lot of trouble with regime filters. The problem is if you're using cycle analysis, you're always in exactly the wrong position when it switches into a trend. And I have no luck myself switching regimes, so my methodology is I simply quit trading that symbol when it goes into a trend longer than my monthly cycle time horizon.
Okay. Sean also asks, have you used the Hurst coefficient as a regime filter, or also any autocorrelation indicators?
The Hurst coefficient is better estimated than calculated. I can measure the Hurst coefficient two different ways, basically with the same concept, and get two different answers. It's also wildly divergent depending upon how much data you use in its calculation. So for those two reasons, I have not been able to use a Hurst coefficient as a trading tool. It's an excellent concept, and in fact, it feeds into the fractal structure of the market that I described earlier. It describes when the market is trending and when it's not from a theoretical perspective, but I've not been able to apply it practically.
Okay. Now, Sean also has a question about the super smoother. He asks, should the super smoother be used to replace moving averages of any sort? I've found it seems to work decently as a replacement for simple and weighted moving averages, but EMAs it works sometimes and not others.
Absolutely, yes. Super smoother is a smoothing filter like an average, and for the same amount of smoothing in any of these other that he mentioned, you're going to get less lag, and lag is the real enemy of traders. So absolutely, a super smoother should be used instead of a simple moving average or an EMA. While I'm at it, I'll give some tips on an EMA.
Sure.
On an EMA, always use a 2-bar average instead of the simple input. When an EMA is alpha times the input plus the quantity 1 minus alpha times the EMA 1 bar ago. So instead of just using a simple input, use a 2-bar average. What that will do is that will put a zero in transmission in the filter, and that will at the Nyquist frequency. So it's a much, much better filter, and it only costs you a half a bar of lag. So and in the same way, if you're going to use a simple average, use a FIR filter with binomial coefficients instead of 1, 1, 1, 1 for the simple average. Your coefficients ought to follow the binomial, like 1, 2, 1, 1, 3, 3, 1, 1, 4, 6, 4, 1, and so forth. Those also put zeros of transmission at the Nyquist frequency and guarantee that you're going to get a smoother result because you're limiting some aliasing and some of the 2-bar, the really short cycle jaggedy responses. You'll knock them way down.
Okay. All right. Thanks, John. And one final question from Sean regarding the roofing filter. How can it be used as an indicator in mean reversion and momentum systems, and should the lengths be optimized depending on the system?
It itself is a good oscillator. What you're doing with the roofing filter is on the high frequency side, you're removing the high frequency components. And on the low frequency side, you're cutting out the low frequency components. So you can independently set the corner periods of high frequency side and the low frequency side to basically form a bandpass. And you can move those around to best fit the market conditions for whatever you're looking at. Optimizing, yes, you can put it into a trading system and optimize the two parameters because you're using it in conjunction with a following indicator of some kind. Or if it's just an oscillator, you're using it to cross a threshold or crossing zero, etc. And you can find the best set of conditions by optimizing.
A little bit more about filters and oscillators here. A question from Larry. He starts off by saying, thank you for being generous with sharing your work in publications such as Technical Analysis of Stocks and Commodities. Now, his question is basically you've provided a lot of research in recent years, and he would like to know if you can specify one favorite low lag filter and one oscillator as your favorite. So what would you say to Larry there?
Okay, I think there are. I will answer the question directly.
Sure.
The best low lag filter that I have is called a decycler, and what it is it's the difference of two high pass filters, and you take the difference, you get the filtering by cancellation. High pass filters have almost no lag at all. Just maybe a half a bar lag or a bar lag. And so when you take the difference of the two, you don't get any computational lag to speak of, but yet you get the smoothing by cancellation. And that is covered in chapter 4 of my book. As far as an oscillator, I have two answers. My best oscillator would be the roofing filter, so you can independently control the upper and lower edges of the band of the spectrum that you're looking for. And that's probably the best solution because it has the least energy storage within the filter. There is a bandpass filter that makes an excellent smoothing oscillator, but you have to be careful with that because if you narrow the bandwidth too much, it will start to ring like a bell. And so you're looking just like a bell. You don't see the impact of the clapper hitting. You see the ring out of the bell. And so you're looking more at the filter than you are at the data if you narrow the bandwidth too much on a bandpass filter. So the roofing filter has less energy storage. It doesn't ring out nearly as much, and it would be my preferred oscillator.
Okay. So when you said, when you were talking about the low lag filter and you mentioned chapter 4 of your book, were you talking about the rocket science book?
No, I'm talking about Psychoanalytics for Traders.
Oh, right. Okay, cool.
Rocket Science for Traders was an earlier book. It's still a good book, has a little bit different information, but the latest information and my latest research is in Psychoanalytics for Traders.
Okay, great. Thanks for clarifying that. Okay, and a question from Decalogue. I hope I've pronounced that correctly. Most of John's articles I've read in the past include easy language code, which I assume is a simplified implementation of the underlying DSP theory. Would it be true to say that using dedicated DSP software such as a C++ library or MATLAB or Python toolbox would provide better results?
I don't think so. And the reason is that trading indicators and oscillators and filters, all by their very nature, have to be simple. The biggest enemy of traders is lag. And if you can't get a timely answer, it's no good. I could make an out-of-this-world filter, but you might get the answer tomorrow. And that, so what is baseline. So all of these advanced tools probably are unnecessary. What you need is a real understanding of the lag of calculation. For example, a simple moving average will necessarily have approximately the lag will be half the length of the moving average. And you see that a lot because people try to recenter the moving average. So that's a real easy example of computational lag. So that's why a simple thing like taking the difference of two high-pass filters that have low lag makes makes a low lag decycler and smoother by cancellation rather than by direct filtering.
All right, thanks, John. Next question is from Zach, and Zach would like to know: is the S&P going up, down, or sideways?
Well, if you look at the S&P over the last 2 months, there's no question it's going up. My time horizon is 2 weeks to a month because I'm only looking at the cyclic activities. I'm only interested in the overall direction of the market in the sense that it provides a bias to my cyclic trades. And there's no doubt there is a bias. It's much easier to write a long-only trading system than it is to write a long-short trading system. And so the bias does impact things. And overall, I just due to inflation and economic growth, necessarily the market heads up in the long run. But in the short run, I've got to go with the cyclic activities, even as short time frame as intraday.
Okay, I should probably add as well, because people are probably going to wonder, the time of this recording, we're late March 2016, so I know people will probably be thinking that when they hear your response. So thanks, John. So the next question is from Grace. Grace would like to know, do you give trade calls?
I have not up to now. I do have a StockSpotter.com system that gives timing signals on stocks. However, I've got a new endeavor coming up. I'm going to offer a leader follower opportunity with World Cup advisors. And the way that works is I will be trading my own account with Robbins Trading, and other traders can follow my signals exactly as a follower, and so they can take the trades as I take them. And so that's coming up in April. And I know we're doing this in advance, so I assume that will be in place by the time this reaches the air.
Yep. Okay. All right. If that is in place, I'll have a link to that in the show notes page, so people can go and check out some more info for that one as well. But that's good to hear. Thanks, John. Now, a little bit of a change of pace to money management. We've got a question from George here. And he says, in the past, traders have considered ways of reducing system drawdown by trading the equity curve. Have you considered quantifying this money management of a trading system using standard engineering methods, such as a classic PID controller algorithm, to simplify things using only part of this, the PD?
Yes, yes. To automate it in a closed system is kind of difficult because you never know quite what the timing of the signal is. I think my preferred approach would work as follows. To have two pretty good trading systems operating in parallel as phantom systems, and they each create their own equity curves. Now, any system can have a loss, so 3 losses in a row, say. And so if you set the standard of saying the equivalent of 6 average losses in a row as being a drawdown or against your equity curve, you can flip a switch, go from system A to system B, and switch over to that system and hopefully that system B is in its prime when system A starts to falter. Almost every system goes into a period of drawdowns, and so by doing an open source, open system switching is one way of doing that, and I've done that, and that works out pretty well.
Okay, thanks, John. Now, I just noticed there's one here that I've missed. You have kind of touched on it already, but I'll ask it anyway in case you've got some more to add. It's from Anthony, and Anthony would like to know if you classify market types, for example, bull, sideways, and bear, using digital signals, and if so, how?
I don't. My time horizon is like I said, 2 weeks to a month, and those are the cycles I'm looking at. I prefer to trade. Currently, prefer to trade index futures, for myself, and the reason is that the index is basically an average of all the stocks, and so any individual stock tends to be a little bit news driven. Whereas if you're looking at an index, you remove that unknown a little bit, and it smooths out the response to your trading. So, short answer is no. I don't look at long-term time horizons or bulls or bears. I'm looking strictly at the opportunities for typically a 10-day move.
Okay. And have you found that there's particular markets that work better with cycles and some that don't?
Yes, again, the index futures work really good. If you stop and think about it, and I don't assign causality, but at every level in every company, from middle managers on up, they have to make their numbers by the month. And so there's kind of a fundamental backdrop for the market having a monthly cycle. And that's my observation. By and large, in the indexes, I see a persistent monthly cycle. And that's something that I can jump in and take advantage of with a position that only lasts 2 weeks. And so that's why I trade that way. So index futures, any of them, ES, NQ, TF, EMD, all of them tend to have the same characteristics.
Okay, thanks, John. Well, I think we'll just start wrapping up now with a few quick closing questions. The first one, what's the biggest lesson that you've learnt through trading?
The biggest lesson is I've learned to be humble. When you're winning, you think you're a genius. Not so much losing. And so you have to recognize that the market does what the market wants to do, not what you want it to do. And parenthetically, if you find yourself hoping that the market will turn around, the prices movement will turn, that's the time to exit, because hope has no value. It's kind of a secondary thing. You really have to have enough capital to trade, to weather through adversity. And one of the most, not my problem, but a problem I've seen with a lot of traders is when they run into adversity, they've been trading a system, they'll drop it and they'll jump over to another system that's been hot, and then that will fade away, and then they'll jump to another one. And they're always making the same mistake. So I think they need to do the research ahead of time, pick a strategy or a trading method, and stick with it, because all strategies and all methods have adverse conditions. And when you jump around, you're just repeating the same error over and over.
Yeah. So what do you think is the most important ingredient to becoming a successful trader?
You have to be decisive. You can't chew on a decision. You have to look at a situation and be able to pull the trigger right now, and never look back. And if that and have the ability that if that trade fails, to put it behind you, not worry about it, look to the next trade, because that's the next opportunity.
Yep.
And also, you can win a lot by not losing. That is, I'm sure most traders have heard the old saw that if you lose half your money, when you start again, that means you have to make 100% just to get back to break even. Yeah. So be careful of losses is a big thing.
So what about someone just starting out in trading? What advice would you give them?
first and foremost, make sure you have enough capital and that you can afford to lose it. Most successful traders have lost their entire stake several times over their trading lifetime. So be sure you're capitalized, be risk averse, and try not to lose. And don't jump around from system to system. Make up your mind before you jump in and start how you're going to approach the trading process, and pretty much stick with it unless it falls apart completely. And idiot was something that obviously doesn't work.
Yeah. Okay. Do you have any favorite trading books?
I mentioned Perry Kaufman's, and I can't avoid putting a plug in for my own books, Psychoanalytics for Traders.
Okay.
That comes with code, by the way, for that fits right into TradeStation and multi-charts.
Yep.
So all the code in the book is, you don't have to key it in yourself.
Yep, that's handy. And so what's the best way for listeners to get in touch with you?
My email address is Ehlers, EHLERS, at mesasoftware.com. That's MESASOFTWARE.com. And I try to answer every one of my emails.
Okay, great. Thanks, John. Now, before we go, I understand you're organising a workshop in cycles for later this year, which could be a great opportunity for traders who want to learn more about cycles and using them in trading strategies. So can you share a little bit more information about that workshop?
Yes, I'm planning an intensive 3-day workshop here in San Simeon, California, right near Hearst Castle. It will. I'm going to start with basics and go through every one of my preferred techniques. So I will be teaching filters and what makes a good filter, and the techniques. Something like I'll have lots of tips like that EMA technique of using 2-bar average instead of. That's a simple technique that has a high impact in your trading. But I'll be talking about some of the most intensive things that I do, and sharing all my research experience. I'm going to bare my soul, and all that's required is to sign a non-disclosure agreement. I will be disclosing to members my MESA algorithm, which I've never shared with anybody before. So that will be part of that seminar. It'll be a magnificent seminar, in my opinion. So if you would be so kind, Andrew, as to put the link to pre-register for that on your website, I'd appreciate it.
Yep, sure will. I'll make sure that I do that. So that sounds like a fantastic opportunity for people who are interested in cycles. Now, is there anything else that you'd like to mention before we wrap up today?
Well, that would be cycles and all DSP. I'll be talking about all the DSP advanced techniques that they can use.
Okay.
Yep. No, I appreciate the opportunity to talk to you today and reach your audience, and I hope I've given some tips that are of benefit. And if I can be of help to somebody that has a specific question, I'm not a trading advisor. I can't give trading advice, but I can address technology, and I'd be more than delighted to do that.
Okay, fantastic, John. I'd just like to finish up by saying thank you for the time that you've spent with us today. I feel like we've really only scratched the surface, because you have such a large and unique body of work that we could have covered a lot more. But thanks anyway for sharing some of your insights into cycles and DSP concepts. It was a really interesting chat today. So thanks again, and I wish you all the best.
Thank you again, Andrew.
Cheers, John. Thanks. Okay, great. So a big thanks to John for our chat today. And I'd just like to finalise a few things that were mentioned in this episode. Firstly, as John mentioned towards the end of our chat, he's organising an exclusive 3-day trading system development workshop where he will be teaching how to utilize his MESA and DSP technology in the development of automated cycle-based trading systems. So if you're interested or would like more info, I have a link to that on the show notes page. So head on over to bettersystemtrader.com/48 and you'll find the link there. Also, John mentioned that he was starting a leader-follower program for World Cup advisors, but at the time of the recording, he wasn't actually sure of the release date. But as you heard in the sponsorship statement, that is now available. So if you want more info for that one too, I also have a link for that on the show notes page, bettersystemtrader.com/48. Plus, if you have any questions or comments about this episode too, you can post those on the show notes page. I'm interested to hear your comments on the chat with John today. And finally, I'd like to say a big thank you to all those people who submitted questions for John. In a few days' time, I'll be sending out an email to submit questions for another very well-known trader. She's been trading successfully for a very long time and has some incredible knowledge and experience to share with us. So keep an eye out for that email in your inbox. You can submit a question of your own using that. Anyway, that's it for this episode. I hope you enjoyed the chat with John. I'll catch you at the next one. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.